Well, hello. We're kind of getting to the end here of the year here.
Yeah.
So getting into the holidays. Got some big plans for Thanksgiving?
There are always big plans with family, right?
Well,
So
that's
it's
true.
fun to get together with family. So that's next week, coming up here soon.
That's right. That's right.
We've had a very interesting year this year. Things took place that were kind of surprises
Yeah.
that we're going to kind of go over. But I think in other things, we've got some pleasant surprises too, looking at where the economy is and where we're going into 2024. So
True. I think we got some positive things moving forward here. So I'm going to start out with the economic outlook. It's kind of interesting. We've started out the year with some pretty negative forward-looking thoughts relative to, are we going to go into a recession? How bad is it going to be? But at the end of the day, things are starting to pan out looking much nicer. And what we're finding there is a much greater confidence in the looking forward relative to the economy and how 2024 is going to shape up for us. You've got two charts here. On the right-hand side, you've got the outlook scenarios, which in the blue, you've got soft landing, slow growth, mid or mild recession, and then you got normal recession. And then looking a little bit further over and towards the top, you got prior and current. In other words, prior being what was being forecasted before today, and current being where are we today. And you can see that the normal recession is kind of off the table at this point. It really looks like we're more likely to have a normal recession. But the good part, maybe even the better part, Rocky, is the soft landing or slow growth is growing as the potential. Then on the left side, you've got the recession probability. Looking at that chart, you've got Blue Chip Consensus Forecast, Bloomberg, and City National Rockdale. City National Rockdale, they're in the top quadrant, I guess, of that chart, where there's a 60% probability of recession. Bloomberg kind of thinks it's going to be about 55% chance of a recession, and blue chip stocks, the bigger company forecasts, are basically thinking it's a 50-50 chance. You blend it all together, what do you got? Well, you got estimates, that's what you have. But all in all, what you do have is the fact that things are looking better. So the key changes from a recession standpoint is there is a reduction in the normal. Mild recession base case has actually gotten better. One of the reasons, well, the Fed tightening and the constraints on consumers plus business lending has tightened things up a little bit, slowed things down. The consumer, the consumer has actually been one of the anchors in this whole probability game here relative to how we're going to turn out. And the fact is the consumers, they've got a relatively strong household balance sheet and real income. In other words, their income is holding better. They're getting the raises, the income's coming in. Why is that? Because there are labor shortages. And because of the labor shortages, it's keeping the unemployment at a minimum. Now, the feds may not like that, but their game is to get unemployment up to slow things down, and the average consumer would just as soon stay employed. And it's favoring the consumer at this point. Now, when you look at the mild recession ahead and you start looking at the numbers, this actually bodes very well, especially from a stock market standpoint, and I'll talk a little bit about that later. But this chart shows City National Rockdale's forecast. So in the blue are the key points, and then on the right side, you've got 2022, the numbers that actually came in. You got 2023 estimates and 2024 estimates. So looking at the real annual GDP growth, well, that's going to be waning over the next year and a half. The 2024 estimates are anywhere between 0.5% and 0.75. Corporate profits, on the other hand, are the positive note here. 2022, they were at a little over 5%. 2023, that's been a little bit tougher, -2 to 1%. But in 2024, their estimates are actually showing a pretty positive year, which bodes well for the stock market. Your headline CPI year end for 2022 ended up being at 6.5%, which is rather high historically, when you look over the last 10 years. 2023 came down quite a bit. 2024, it would bode well again for corporate profits as the CPI goes down, which means costs go down. Then you look at the Fed funds rate. The Fed funds rate, even though it looks high right now, it will be starting to wane in 2024. Again, that bodes well for corporate profits. And then the Treasury notes, well, we've been following them. Short term tends to be better, but it looks like it's going to hold relatively the same for 2024. So interest rates are coming down. We look at 2025 in the future, and hopefully we'll get them down to something where everybody feels a little bit more tolerable. Now let's talk a little bit about geopolitical risk. It looks like we've got a lot going on right now. There's certainly a lot of emotions relative to the issues that are out there, but I want to talk a little bit more about the percent of GDP relative to each one of the economic areas, looking at, let's say, the US and the China alignment blocks, as well as those that are unaligned. When you think about China and their allies, they're in red, and they represent about 25% of the GDP. Conversely, you look at the US allies, basically the free world, and that represents about 68% of the world GDP. And then you had the unaligned, which is 7%. Now, why do we bring that up? Well, a couple reasons. Number one, when it comes to global business, and industry policies, when there's turmoil, it makes it much more difficult for companies to make long-term decisions, and profitability is waning in those areas. So it's actually affecting the U.S., probably more of the U.S. allies more, relative to how it's going to affect the GDP as a whole. But let's make no mistake about it. China and their allies are going to have problems because they're kind of in the thick of what is going on out there from a global unrest. And really, tensions are getting a little bit more acute when it comes to that global risk. So when you look at the speedometer for global risk, it is getting more negative. There is a lot going on out there. And when you look at the three major issues, you got China and Taiwan. Well, there's the chip war that's still going on. The military tensions in the South Sea are worsening. I mean, let's face it, China is rattling their saber, and it doesn't appear that anybody wants to curtail them. And then you have Taiwan. They have an election coming up, and that's a little bit of a wild card, which could go either way. So you've got China and Taiwan. Then you've got Russia and Ukraine. There's a stalemate, kind of what it looks like on the battlefield. It doesn't look like there's an end in sight here, which means this could drag on for years. And then you also have to watch for any kind of escalation in sanctions, because anytime you do that, that's going to impact oil, certainly going to impact the EU economy and the overall activity out there, just like it has in the most recent years. And then most recently, you've got Israel and the fact that Hamas attacked, very surprisingly, Israel. So you've got Israel, Hamas, and the Mideast as a whole. And the question is, is there going to be regional escalation? And that is a possibility out there. There could be some global entanglement, but it's not likely. Usually when there's Mideast wars, the rest of the world doesn't get involved so much in it. They support, but they don't necessarily get boots on the ground. But there will be an impact on oil. There almost always is when there's a conflict in the Middle East. So geopolitical risk is certainly high, and it's sad, but you look back 3 years ago and nobody would have foreseen this coming, especially with all the peace talks that were going on with the prior administration. But this is where we are today. Now, let's look at the economic speedometers in comparison. Where are we today compared to the beginning of the year? Well, if you look at it, it looks like it's gotten a little bit better. And really, if you drill down on each one of the economic indicators, you'll see that there's actually 11 indicators that are more positive than they were in January 2023. However, there is a flip side to that, and that means that there's also 6 areas on the economic indicators that are worsening a bit. And then there are 3 that have been neutral for this year. The interesting thing when you're talking about the economic indicators is that if we haven't hit the bottom yet, which we do not think we have from an economic standpoint, it will sway back and forth. So as long as it doesn't get really red, things start turning for the real worse. This is kind of a normal position. If you ever went back and looked at all the economic indicators throughout different cycles, you'll find when we get to this point, it ebbs and flows until we actually hit the economic bottom and move forward. So kind of interesting. We've got a lot going on this year.
Yep.
And I think it's going to be a bit volatile still.
Inflation, recession, wars, just the normal stuff we deal with when you're dealing and talking about the markets and how they respond to the economy, world events, so on and so forth.
True.
Anyways, that was good coverage of like some of the detail. What I want to do is take a minute here to talk a little bit about kind of a 30,000 foot level of the things we're seeing economically coming into the end of the year, going into next year. So let's kind of go over it. Some of it's repeating some of the stuff Dan talked about, but I want to make a good summary here going into year end of 2023. First of all, the GDP outlook is turning out much better than what we expected, as Dan touched on, and that's because of the resiliency of the household finances and the strong labor market. Inflation, while it's still elevated, continues to move downward. What we heard just this week, in fact, is that the October CPI came in at 3.2%, which is lower than September, lower than prior months. Go all the way back to the peak of last year was 9.1% in June. So a little over a year ago, our inflation rate was skyrocketing.
Ouch.
So they've got a lot of things under control. The Fed is doing its job by trying to curtail that inflation without totally killing the economy. Talking about the Fed, the next point, they're likely at the end or near the end of its hiking cycle. The one thing that we're noting is as this recession has been drawn out, the projection of going into recession, we thought it was going to happen the second half of this year. Now it looks like the first to second quarter of next year, and it's going to be milder than we thought. That tends to make those rates stay higher for a little longer. So that's the point of this bullet point here. Another thing too is that recently the increase in the 10-year treasuries, they actually touched 5% here in the last couple of weeks. And when you have a sustained high treasury yield, that's an actual negative from consumer and corporate spending forecast looking forward. And the reason being is that when rates are high, investors tend to take the safety of a high given rate, certain rate, fixed rate, versus the risk of the equity market. So the money has not flown back into the equity markets like we expect. However, the next point is talking about, we're actually expecting modest GDP growth next year. So the fact that we will expect to see some signs, as Dan talked about earlier, that, profit growth projections could be somewhere between 6 to 10%. That is a sign that maybe, we need to be looking at investing in the equity markets before this thing takes off. Another point here is banks are reducing lending. That's part of the slowdown. So not only are rates higher than they've been in the past few years, the banks have restricted and made it more difficult for consumers and businesses to borrow, which tends to slow down business and economic activity because there's not as much borrowing to finance things going on looking forward. And this last bullet point on this page is the job gains and real wage growth have been creating more of a resilient consumer, which has been spending this year, keeping us out of that recession. But we're starting to see that tailwind abate a little bit or slow down. So the probability of a soft landing or no recession at all has actually increased, as Dan pointed out. We're expecting a possible mild recession here in the first or second quarter of 2022. That remains our base case, worst case scenario. Hopefully it's a little better than that. Earnings growth in 2024 will pick up. As Dan alluded to, we're projecting 6 to 10% growth by the end of 2024. So that activity will start to recover in the second half of next year. But if you're thinking as an investor, you want to be ahead of this. You don't want to be told, the earnings on these companies are going up, and then try to buy their stock. You want to be owning it before. You want to buy low, get the good news, and watch the stock values go up as they start growing their earnings projections at the end of 24 going into 25. The U.S. economic outlook is definitely more resilient than the European and Asian economies. Again, we've been talking about this. We're staying U.S. based with most of the investing. We're underweighting overseas, overweighting U.S. from a equity position looking forward. And as Dan concluded just a minute ago, the geopolitical risks, they're out there. They create short-term volatility, but it's really historically been a very minimal impact to the U.S. economic activity. However, it's something we have to keep an eye on going forward. So,
well, that was a lot.
Yeah. Well, we condensed a whole bunch of stuff in 2 minutes. So that's the economy. So I think now the question is, well, what does that mean for the market and the strategy for the portfolios going into 2025?
Yeah, I think it's very positive moving forward, and I'm going to kind of get into that. So let's look at the investment strategy and planning moving into 2024. Now, we've talked about this a lot. It bears repeating, but the S&P 500 Capital Weight Index, this is the index that everybody sees on TV. It's shown with the NASDAQ and the Dow. But as we've reported, the S&P 500 and the Dow, which usually kind of ran in tandem, separated. There was a divergence right around May of this year where the capital weighted index moved forward, up, continued to get the gains, and the Dow Jones started going sideways. And people ask, well, why is that? Why is there a divergence? Well, again, it's because the S&P 500 is capital weighted. Well, what does that mean? Well, think of it this way. News Corporation is literally the smallest company in the S&P 500, and it represents about 0.008% of the S&P 500 index by weight. Again, a small company. Conversely, you've got Apple. Apple is 777 times the weight of that smallest stock. So as you can imagine, it has a much greater weight from a input or return standpoint within the S&P 500 index returns. Now, in the S&P 500, you've got the tech titans, 7 or 8, depending on who you want to talk to, but they represent 25% of the overall weight of the S&P 500. Well, conversely, that means you've got 492 or 93 stocks that only represent 75%. And the illusion out there right now is this. Those tech titans are killing it. In other words, they're up 50%, 75%, 100, 120, 140%, depending on which one of those stocks you look at. And that is actually putting them in a position where the S&P 500 capital weight returns, generally about 92% of the returns are those 7 or 8 stocks. Now, looking at this chart, you can look back where the bottom was in 2022 of the S&P 500 capital weighted. Now, what I want to show you again is really how is the broader market running? Is it on a tear like the capital weight is, or is it going on a different trajectory? Well, this is the S&P 500 equal weighted. The equal weight means that News Corp, the smallest company, has the same returns from a weighting standpoint as, let's say, Apple or Amazon or Google or name any one of the 8 tech stocks. That being said, it gives you a better understanding of what the broader market is doing. So from the broader market, you can see we hit bottom again in October of 22, but we've pretty much violently walked sideways. Now, I'm going to take it a step further. So that's 500 large cap stocks. What about the Russell mid cap, which is 3,000 stocks? Again, hit bottom in October of 2022 and is on a downward trajectory towards that bottom again. Could very well be that double bottom that everybody's looking for. But this is 3,000 stocks, again, that's going sideways. What about the Russell 2000 small cap stocks? They actually hit the bottom just recently and are moving back up, but again, violently. But it's on a sideways trajectory. Now, could this mean that we've hit the bottom in the Russell 2000 and are ready to go forward? Well, that remains to be seen, but certainly we are a lot closer today than we were 6 months ago. And as Rocky said, I think we want to be positioned in the equities market to be able to get these returns. And there's a chart here that I want to show you, which really talks about investing in periods of uncertainty. This is a very critical chart for anybody who's questioning whether they should be in the market right now. This really should put the icing on the cake as to why you should be in the market. So when you look at this chart, on the left-hand side, it shows 0 returns all the way up to 140% returns. On the bottom, you've got 1982 recession all the way up to 2022. The chart is basically showing 1-year returns off of a bear market low. The dark blue bars are the S&P 500. That's the capital weighted returns. The light blue is the S&P 500 equal weighted returns. And the gray blue is the Russell 2000 returns. And as you can see, and we're not including 2022 yet because we don't believe we've hit that second bottom yet, But looking at the previous 6 bear markets, you can see that if you're in the market ready to take off, if you're fully invested, you've got a very high probability, if you're allocated properly, to maximize your returns 1 year later off that bear market. And more importantly, you want to be diversified. You do still want to have small cap stocks, because if you look at this, out of those 6 bear markets, they led the way 7 out of those 6 returns, bouncing off 1 year later. So we absolutely want to be diversified. You know, every time we do these webinars, I get more excited, because as the numbers start coming in, it is really showing that we're poised where we should be. So when you're looking at what's happening in the market, you're looking at these charts, you're looking at the potential returns, though it may be a little bit too early to call it, I think we're very, very close. So what does that mean? It means that even with this mild recession, we're going to see some serious stock participation. And keep in mind that the stock market hits bottom and takes off before the economic cycle hits bottom and takes off. So let's kind of recap here the investment strategy going forward in 2022. First, again, the geopolitical risk and trade tensions are elevated. So there is a bit of a risk out there, so you want to be a little bit more defensively allocated, but definitely with equities. There is going to be volatility, but it will also create buying opportunities in the worst case scenarios. And as Rocky had mentioned, we're going to pretty much stay away from Europe and Asia equities because I think it's going to be a bit of a time before they actually get into a position where there might be a good buying opportunity. And then from a bond standpoint, investment grade corporate and municipals, man, they're starting to look attractive out there for anybody who is really conservative. And if you think about it, over the long term, high yield bonds are basically fully compensating investors for high quality in this volatility. So it's not looking bad at all. And I don't know, Rocky, any final words on that?
No, I think we are seeing the light at the end of the tunnel.
Yes.
And it wasn't as bad as we were expecting. I think that's a huge point to make. It strung out a little longer than we thought. We thought we might have more of a V kind of recession and then come out of it. No, we're kind of slowly, painfully slowing down.
Yeah.
But we will hit the bottom and we will take off again.
Yeah, this recession and market correction might be as long as the 2000 to 2002, which was 2 years and a quarter. So we're coming on that. All right. Well, basically, if you have any questions, we have solutions. We are a full wealth management service firm. It's not just investing. Obviously, the investing fuels everything that we do, but it's really more the advanced planning, the wealth enhancement strategies, wealth transfer strategies, wealth protection strategies, and charitable giving strategies. All these are actually incorporated with the investment consulting to enhance our clients' overall net rate of return. If you'd like to see more, you can just go to our YouTube channel at Daniel Krugen Associates YouTube. The easiest way to get there is go to mydkna.com. That's our website. Click on Watch Us, then DKNA YouTube, and it'll bring that site right up for you. And then you can look at all the full-length videos or the short snackable videos if you'd like. So that's pretty much it. So there's no real need to worry. We're going into the holidays. You take care of your family and
we will take care of you. Make sure that you guys enjoy your Thanksgiving and Christmas holiday seasons.
Absolutely. Merry Christmas.
Goodbye, everybody.